Okay, we're going to look at exercise 22 on how to do the additional information. Okay, so recap again. For every piece of additional information, there will be two adjustments which need to be done. Okay, so let's look at the first additional information. What are the two adjustments? Okay, the first additional information says that inventory includes goods which cost 3500 damaged by water, net realizable value of only 2800. Okay, when you are given, this is when you are given two values like this, okay, you have to pick the lower value. So between 3500 and 2800, you must pick 2800 as your inventory value. Okay, this is based on the prudence concept, where between cost price, you always pick lower of cost or net realizable value. You always pick inventory is always valued at the lower of cost or net realizable value. So given two values here, 3500 and 2800, you always pick the lower one. Alright, so this one will become your inventory value. Alright, so come again. What happened over here is that the goods originally worth 3500 now dropped to 2800. Okay, because it's originally worth 3,500, but based on the net realizable value is now stated as 2800. So this batch of goods, this same batch of goods, okay, now worth only 2800. You're gonna bring the value of the goods down from 3500 to 2800. Okay, so inventory value dropped by 700. Okay, you're gonna minus directly from your inventory account. What, 17,600, you're going to minus 700, bring it down to 16,900. Okay, then why are we directly deducting from 17,600? Because they are saying that this batch of goods, 3,500, actually belongs, okay, to the inventory. The whole inventory is actually 17,600, but 3,500 is only part of it. Okay, and they are saying this part of it, as part of this 17,600, this part of it, 3,500, okay, has a new net realizable value of 2800. Okay, based on prudence concept, always pick lower of cost or net realizable value. We pick 2800 now. This batch of goods now dropped to 2800, so it suffer a loss of 700. This impact the whole batch of goods, your whole inventory now also will drop together. So 17,600, you need to minus 700. Okay, the moment inventory drop, assets drop, okay, you suffer a loss. This loss is called impairment loss on inventory, which is also $700. Take note that this account here, impairment loss on inventory, belongs to expense, so you will later show it in income statement. Okay, next, additional info 2. Okay, says that included in rent and insurance was an annual insurance of 9,000 paid on 1st of Jan 2015. Okay, what is this sentence trying to tell you? Basically, this insurance, right? Okay, this insurance coverage is from 1st of Jan 2015 to 31st December 2015. How do I know it ends? How do I know the coverage is from 1st Jan to 31st December 2015? It says that this insurance is annual. Okay, this is a yearly insurance. So you pay one on 1st of Jan 2015. The coverage will be 12 months all the way till 31st December 2015. Okay, then since you after you know that this insurance cover from 1st Jan to 31st December, okay, worth $9,000. Okay, then the problem is our question here. Okay, this financial statement period ends at 31st July 2015. Okay, but our coverage is more than that. Our coverage is from 1st of Jan all the way until 31st December 2015. So anything after July, okay, we consider them as prepayment. Alright, so after July you have 8, 9, 10, 11, 12. You have 5 months of prepayment. Okay, what you're going to do is you're going to break $9,000 down into 12 months. Break it down. You're going to find the prepayment. So 9,000 you're going to divide by 12. But you're gonna then you find the 5 months of prepayment. So 9,000 times 5 over 12 give you prepaid rent and insurance expense of 3,750. Okay, so this is prepaid. Because this is prepaid, it's not meant for this current accounting period. You're gonna remove it. So from the amount given in front, $19,000 of insurance expense, rent and insurance expense, 19,000. Okay, you're going to remove it. Okay, 19,000 minus all those which is not belonging to current accounting period, will give you your new rent and insurance expense of $15,250. Okay, so that's all for additional info 2. Move on to additional info 3. Additional info 3 says that there's a debtor, okay, Sean, declared bankrupt, insolvent. Okay, debt is to be written off. Someone bankrupt. Okay, what do you need to do? Remember, this is a bad thing. Someone went bankrupt. Okay, adjust 2 places. First, go to trade receivables, deduct $400, change it to 7700. Then bring down the allowance. Okay, both sides need to minus. Okay, bring down allowance, 900 minus 400, give you 500. Where did 900 come from? 900 comes from the front. Okay. Over here. Okay, so basically we are just adjusting figures from here, all right, based on information given here. Okay, all these additional info. So repeat again, for additional info 3, you minus the 400 from trade receivables. Okay, and you minus from allowance. Okay, bring them down. Okay, because it's confirmed a loss already, just deduct directly from the trade receivables. It's no longer an estimate. Okay, so you just minus from the 900. Okay, after that is done, we have additional info 4. A review of the trade receivables showed that an amount of 400 owing by Yixiang may be uncollectible. So this one is actually telling you the new amount of allowance for impairment of trade receivables for this accounting period, for the current accounting period. So far, okay, after we have done additional info 3, right, we arrive at the conclusion that that our allowance so far, okay, has been adjusted from 900 to 500. Okay, but then they are telling us a new piece of information that this year's allowance is supposed to be 400. Okay, so this is actually our old amount. We're going to shift it down to 400. Okay, we don't really we just follow the question. Okay, always remember to follow the question. The review will tell us how much is the allowance, and that will be your allowance for your answer. So 400 will be your final allowance. Okay, this is the amount of allowance you must arrive at. Okay, the answer you must give me. Okay, inside your balance sheet, less allowance for impairment of trade receivables. It should be 400. Okay, so any adjustment you do in 3, right? Okay, you change no matter what number. Okay, maybe you change this to 200, change this to 600. Okay, I don't care what number you change to. At the end of the day, because of the question, it says the allowance is 400. At the end, I must get back allowance 400 here. Okay, so over here, the previously 900 minus 400, so become 500. 500, I must get back to 400, so 500 deduct 100, go to 400. Notice what happened here is that the allowance actually dropped. Okay, from the old one, adjusted old value, okay, to the new and final amount. Okay, 500 to 400 is basically a drop in allowance. A drop in allowance is basically less people who may be unable to pay up. Basically, it's a good thing. Okay, so we don't really treat it as a loss. We call it reversal of impairment loss on trade receivables. The change, okay, which is 100. Okay, this records the change, not 400, not 500, but the movement. Okay, how much was moved? 500 to 400, $100. So reversal of impairment loss on trade receivables, $100. Okay, then we look at info 5. Repairs which have not added value to motor vehicles have been recorded in the motor vehicles account, so it does not belong to motor vehicles. You must remove it. Okay, so original value 75,800 minus 2,000 give you this number. Then repair expenses not recorded yet, right? So you have to go and record. So it will be 2,000 here. Okay, that's it for info 5. Then you move to info 6. Okay, look at info 6. Basically, they are saying that property is broken down into 2 components, basically land and buildings. Land you do not depreciate, okay, because land only appreciates value, does not drop in value. Buildings you have to depreciate. Okay, and they say that building is to be depreciated at a rate of 2% per annum on cost. On cost refers to straight line method. Okay, so how to calculate? Using straight line method, original cost minus scrap value, holding bracket times percentage. Okay, so okay, in this question here, no scrap value is given, so we just treat it as 0. Take original cost directly, 52,000 times 2% give us depreciation. For all additional information regarding depreciation, you always have to do 2 things. One is depreciation, another one is accumulated depreciation. So after you are done with depreciation of property, this will appear inside your income statement expenses category. Over here, this one, accumulated depreciation of property has to be done as well. It has to be adjusted. Take the O plus the new. Coincidentally, both numbers are the same, so you just add them together. 1040 plus 1040, which give you $2,080 here. Okay, done. Okay, that's all for property. Then you go to motor vehicles. Motor vehicles to be depreciated at 10% per annum on net book value. Net book value meaning reducing balance method. Okay, so calculate depreciation and also do accumulated depreciation. How to do it? Depreciation, use back the formula, NBV, net book value, times percentage. Okay, NBV, how you get? Basically take original cost minus accumulated depreciation, holding bracket, times percentage. Alright, notice over here I use what's the number I use? I use 73800. Okay, this is the new original figure for motor vehicles. You see, motor vehicles inside the question, right, if you look in front, right, is 75800. 75800. So why do I use 73800 here? Okay, because after adjustment, got 2000 is not motor vehicles at all. Okay, so you must remove them. So the original value is actually $73,800. Okay, so after that, okay, from here you just use 73800 to do your respective calculation. Take 73800 minus accumulated depreciation, okay, which is given in the question already, 71600. Okay, over here, then you times the percentage. Okay, so the amount will be 6664. Okay, after you are done with depreciation, same thing, you must calculate the old plus the new. Okay, take the new old depreciation amount, the old accumulated depreciation amount plus the depreciation, add them all together, give you 13,824. Okay, that's all for motor vehicles. Okay, next, do the last one, number 7. Okay, this is the bank statement. They says that the bank had debited the business bank account with charges of 50. Okay, well, for a bank statement, to debit means to pay, to credit means to add money. Okay, for a bank statement. Okay, for a bank statement, the bank statement and cashier bank functions differently. Cashier bank DR plus CR minus, bank statement DR minus CR plus is different. Okay, so the bank's debit business account basically means we are paying money. So we are paying $50 for bank charges. Okay, so what you do is you record bank charges $50 expense. Okay, then after that, you're paying out money, you're losing money, so cash at bank should drop. But what happened is that if you look at your cash at bank is already $1,700. CR means you're owing the bank money already. It's already a bank overdraft. So you can't when you pay out, right, you owe the bank even more. So what we will show is by putting down short-term borrowing 1700 plus another 50 because we are paying out even more, we owe the bank even more. The total amount owing will become $1,750. Okay, that's for additional info 7. Then you will wonder, how come I got this additional info 8 over here? Because there's a hidden additional info given. Okay, it comes from here. Okay, this paper is a bit more challenging. They say that the bank loan is repayable on 31st July, okay, but the most important thing is 5% bank loan. So 50,000, you are supposed to pay 5% annually, okay, but notice if I take 50,000 times 5%, I will only get 2,500, but according to the question, right, I only paid 2,000 so far. Okay, I'm supposed to pay 2,500, but I only paid 2,000, so meaning you say 500 not paid yet. Alright, so first, put the interest on loan to the correct amount which I'm supposed to pay, which is 2,500. Then because I have not paid yet, I'll have accrued interest on loan of $500. Okay, at the end. Okay, so with that you can move on to complete your income statement and balance sheet. Thank you.